Stanley Druckenmiller is a hedge fund manager with a stellar track record. Currently, he thinks the United States is headed for a hard landing and is also experiencing the biggest cross-asset bubble that he's ever seen or studied. So in this video, I look at the evidence behind his beliefs, but also look at his stance in terms of investments to navigate the popping of this huge asset bubble. Now, don't forget, if you do enjoy our content, please do subscribe to our channel and also like this video. So let's look at Druckenmiller's beliefs in a bit more detail. So what's Stanley Druckenmiller saying and why should we listen? Well, as you can see in this headline from Bloomberg, what he's expecting is that the US is on the brink of a hard landing. What does that mean? Well, as the Fed raises interest rates, the US is going to go into a recession, and that's bad for risky assets like stocks, for example. Now, that's not to say that there won't be any opportunities at all. It just means that while we go through the rough patch due to the hard landing, there's going to be a choppy period which will create those opportunities. Why should we listen to him? Well, he's had an incredible history of investing, not just in one asset class like stocks or bonds, but across all different asset classes. His net wealth is roughly 10 billion, and he manages his own hedge fund, which manages his money, which is Duquesne Capital. Now, when he did run Duquesne Capital for clients, that's between 1986 and 2010, he generated an average return of 30% per year. That's Warren Buffett's standard. Now, he's made some incredible trades over that period of time. When he worked for the Quantum hedge fund, this is George Soros's hedge fund, he actually made a bet against sterling in 1992, and that trade alone netted $1 billion for Quantum. Then shortly later, he made a bet against the Swedish krona, which again bagged $1 billion. But of course, he's made mistakes as well. For example, in 1998, when Russia defaulted on its debt, he made losses on Russian stocks and on Russian bonds. And the losses were substantial. It was $2 billion. And then in 2001, and he's always beating himself up about this, he lost money in the dot-com bubble. And shortly after that, he left Quantum. Now let's turn to the biggest and broadest bubble Druckenmiller has ever seen or studied. Now, the driver behind that bubble, what's inflated it, has been an era of very low interest rates for 10 or 11 years. And that's inflated a bubble in the stock market in the United States, for example. Stocks have surged over that decade. We've also seen the bond market bubble surge and now pop. And of course, we've seen US house prices surge and then pop. However, he says the grand finale was when the government spent $5 trillion on COVID relief and the Fed financed 60% of that expenditure. And sure enough, if you look at the Fed's balance sheet, it ballooned from around $4.5 trillion up to just under $9 trillion as the Federal Reserve bought lots of mortgage-backed securities and US treasuries. And if we break down expenditure by the US government, this is the fiscal irresponsibility which Druckenmiller's talking about. If we break it down by state, you can see that it adds up to around just under $5 trillion. So how does that lead to a hard landing? Now, the combination of that huge fiscal stimulus, that's government spending, and monetary stimulus, that's low interest rates from the Fed and quantitative easing as it bought up lots of treasuries, led to certain things which didn't surprise Stanley Druckenmiller. The things which didn't surprise him were things like speculative frenzies on things like cryptocurrency, on stocks, on meme stocks. So Bitcoin surge, Dogecoin surge, and the general surge in US equities, particularly growth stocks. But what really did surprise Stanley Druckenmiller was the fact that the Federal Reserve carried on being really accommodative, even as the United States government was spending a lot on COVID relief and as inflation was surging. So he's shocked by the fact that Jerome Powell's Fed had their foot on the gas for a whole year after that stimulus, and they were still buying $120 billion of US debt every month, and they also had zero interest rates. Then the Federal Reserve realized they'd made the biggest mistake in Fed history and had to slam on the brakes. That meant raising interest rates by 5% over the course of a year. So that's part of what is going to cause this problem and lead to a hard landing in the US. Very rapid tightening of monetary policy by the Fed, but also some fiscal problems. What does he mean by that? Well, if you look at this graph from the Congressional Budget Office, this is a nonpartisan institution in the US which looks at the sustainability of US debt and spending. This shows you the size of the US deficit as a proportion of its income, or GDP. If the government's spending more than it's earning, then it has to plug the difference by issuing debt. Now, that's not a problem as long as the rate of growth of that debt doesn't exceed GDP. If it does, then the size of the debt can actually spiral out of control. So if you look at the projected period, this is from 2023 onwards, you can see that that gap between spending and income gradually widens. The size of that primary deficit gets bigger. Now, while interest rates were extremely low, servicing that huge US debt pile wasn't so bad, but as interest rates increase, it's going to become more expensive, and that in turn will add to the debt pile over time. Now, the primary driver of the increased cost of government spending is the aging of the US population. As people get older, they require more medical care, and that's going to be very expensive for the US government. So the solution to that problem is the government's got to either cut spending or raise taxes or both. Now, if they do raise taxes, usually that's seen as slowing down growth. But Druckenmiller's concerned that if the government's having to spend lots of money on healthcare, that squeezes out spending on other things, such as infrastructure, which is more stimulative of growth. Now, what's the upshot of all this fiscal irresponsibility and these asset bubbles? Well, the first consequence is a weaker dollar. And Druckenmiller says that at the moment there's a huge amount of uncertainty in the economic outlook, which makes any kind of forecast very difficult. In fact, he's only got one high conviction trade, and that's to be short the dollar. The dollar rallied hugely during the big sell-offs in 2022 as people sought safety and as the US interest rates were generally higher than they were elsewhere. And Druckenmiller says that that was probably the biggest investment mistake of his whole career. He just couldn't bring himself to buy the rally in the dollar that was fueled by Jerome Powell and Joe Biden. But if he's right about the hard landing, then the consequence of that is that the Federal Reserve is going to cut interest rates and the dollar will weaken. He's also concerned that the United States weaponized the dollar and froze the assets of Russia, which were dollar denominated, after it invaded Ukraine. That's worried other countries that their assets could also be frozen if they're dollar denominated, if they fall foul of US foreign policy. And there are also countries who are saying, why do we have to trade in dollars anyway? For example, he quotes President Lula of Brazil, who he says is asking, why do we have to trade in the US dollar? And Druckenmiller says he's right to. Another consequence is a very popular strategy, which is just to buy and hold the stock market. He thinks that's going to be broken for the next 10 years. So why would US returns be lower over the decade ahead? Well, for starters, margins are very high. They've been creeping up since the early 1990s, and currently they're at very, very high levels. So there's not a lot of scope for those to increase further. And given the high inflation rates, if anything, they're going to fall. Also, the United States market is still quite expensive. There has been a sell-off over the course of 2022, but the rally over the course of this year means that valuations are not much less than 20 times forward earnings. As I make this video, they were at 18.2 times. When you combine that with the fiscal problems and the government not being able to spend on stimulus as much as it could if it didn't have to spend on entitlements, that suggests that the United States is going to have another lost decade, as it did in the 1970s, for example, and as it did in the 2000 to 2010 period. Now, that's not to say that a global index wouldn't have reasonable returns. It's just that you'd have to go outside the US to generate those returns. Or if he's right about the hard landing, what you could do is keep some dry powder now, wait until there is a sell-off, if he's right, and then buy into the market at lower valuations. And some of the opportunities we're about to discuss use that sell-off to do exactly that kind of tactical trade. So turning to the opportunities he sees right now, one of them is copper. And what he says is that copper is in the tightest position he's ever seen. That means that there's fairly limited supply and not much ability to expand that supply while demand is about to surge. So if we look at a graph of copper prices, and here I've superimposed US recessions, notice how the copper price falls when there is a recession. And he actually says he's afraid to have a meaningful position in copper because if he is right about the hard landing, it'll mean copper prices fall. So what he's actually suggesting is that after that period of soft growth, then that's the good time to buy copper after its price has fallen. And of course, we all know the structural reasons why that's a good idea. We've got the move towards electric vehicles, also the move toward renewables, things like wind power generation, which occurs offshore, that requires a lot of copper cabling. Plus, he thinks that if there's a period of weak growth, governments are going to do a lot of infrastructure spending, and that will be copper intensive. So he says it's hard to believe that copper won't be a beneficiary as we come out of that period of weak growth. And if you look at copper stockpiles, and this is a graph from the Financial Times with data from Goldman Sachs, you can see that as we go year by year from 2019 to 2023, the stockpiles of copper have gradually depleted, and if we extrapolate the trend for this year, they should be very depleted by the end of the year. And of course, that would lead to upward pressure on copper prices. Then we turn to precious metals, gold and silver. And in PensionCraft, we have two fundamental models which take various macro factors and try to see the fair price of gold and silver. Now, currently, both of those are pretty close to the model estimates. So, for example, gold is undervalued by around 3% and silver is overvalued by 4%. But what's interesting about this position is that Druckenmiller says that gold and silver tend to do badly during hard landings. But he's willing to override that trend in the past because he thinks monetary and fiscal authorities are kind of at the end of their rope. Also, lots of autocratic governments across the world are buying lots of gold, and that's because they're worried about their dollar reserves, I guess. So for the time being, he says he's willing to bet on gold and silver. So he has a position in both of those, but he says don't rush out and buy gold and silver because he might change his mind very soon. Now, if you do want to get access to those trackers and all the other goodies that go with membership, such as our chat applications, so you can ask a question whenever you want, and literally hundreds of members-only videos, just go to our website, PensionCraft.com, to learn more. Now, another asset class which he thinks could be attractive coming out of the crisis is housing. We saw housing prices surge with a huge fiscal stimulus, but also the monetary stimulus that followed COVID. And although they have started to fall now, he thinks that there could be an attractive proposition there after we come out of this hard landing. So he says that housing has gone down given the tremendous 500 basis point increase in interest rates. But unlike the situation in 2007 and 2008, there's a big structural difference and imbalance which didn't exist then, which is that there's a huge undersupply of single-family homes. And he thinks that's going to be the upward driving pressure on house prices as the Fed cuts interest rates after some kind of hard landing. Growth from biotechnology stocks could also be a big beneficiary. And if you look at this iShares Biotechnology Fund, this ETF, you can see how it surged by 50% in the post-COVID rally, but then lost all of those gains over the course of 6 months in 2022. And still, it hasn't really recovered. But he points out some really exciting biotechnological innovations which could completely transform the industry. For example, we're all aware about drug resistance in bacteria, but in fact, there have been viruses which have been very efficiently killing bacteria for millions of years. And these are bacteriophages, and these can be used to treat human diseases, as this article in The Economist pointed out recently, and this is one which Druckenmiller mentioned in an interview. So instead of injecting an antibiotic, if you get some kind of bacterial infection, you'd simply inject some of these bacteriophages, which are safe for humans. Druckenmiller has also been on the board of the Memorial Sloan Kettering Cancer Center for just under 30 years. And he describes how in medicine, for many years, what we've been doing is poisoning people with these anti-cancer drugs, hoping that it'll kill the cancer before it kills them. Whereas now there's a much more targeted approach, such as anti-cancer vaccines. And here you can see a trial being discussed on their website, which may be innovative for treating pancreatic cancer. So mRNA vaccines could completely transform medicine as it exists now. And of course, he's talking about innovations in AI. And he's very self-deprecating. He mentions the fact that he lost money in the dot-com bubble and says that I hope I haven't been one to buy into fads historically, but he does mention that dot-com bubble loss. But he thinks this could be a real opportunity. If we get a big sell-off in tech stocks, then buying the recovery plays like Google and Amazon in 2000 and 2001 could be a great trade. But he also points out that it's really hard to get exposure, pure exposure to AI stocks, given that they're owned by just a few companies. They've got very much a monopoly on the technology. That's Microsoft and Nvidia, for example, which have seen their share prices surge as a result. So, for example, Nvidia is on a kind of crazy multiple right now of almost 180 times earnings. But still, he thinks this could be some kind of very odd defensive stock, even going into this hard landing. And that's because of the promise of the technology. So there are some really interesting insights, I think, from Stanley Druckenmiller. And I really enjoyed making this video because what I didn't mention is that he's actually quite humble, which is quite unusual for someone with his kind of background and track record. But I'm not convinced that we're going to get a hard landing in the US. I'd probably agree with Jerome Powell that it's roughly 50-50, the odds of that happening. And I don't think it's certain by any means. But still, I think it's interesting to hear what he says and use it as a starting point for your own research to form your own beliefs. So don't forget, you can join our membership. If you're interested, just go to PensionCraft.com. And as always, thank you for listening.